Welcome back to Beyond Four Walls, Conversations on Affordable Housing. I'm David Dworkin, President and CEO of the National Housing Conference, the nation's oldest and broadest affordable housing coalition. I'm joined today by Teresa Bryce Bazemore, a nationally respected leader in financial services, housing finance, and corporate governance. Teresa brings more than 35 years of experience as a CEO and senior executive, including leadership roles across mortgage banking, mortgage insurance, and financial services. Most recently, she served as president and CEO of the Federal Home Loan Bank of San Francisco, where she championed initiatives to expand affordable housing opportunities and strengthen communities. Before that, she held several senior leadership roles at Radian Group, including president of Radian Guarantee, chief risk officer, and general counsel. Teresa also serves on NHC's Board of Governors and is an advisor to our Residential Property Insurance Collaborative, a cross-sector initiative bringing together leaders from the housing and insurance industries to address the growing challenges of property insurance, affordability, and availability. Through this role, she's helping advance collaborative solutions related to housing resilience, insurance markets, mortgage lending, and systemic risk, with the goal of improving housing affordability and stability for homeowners, renters, and affordable housing providers nationwide. Welcome, Teresa. I'm so excited to talk to you today.
Well, thanks, David, and thanks for having me on. It's always great to talk to you.
We have worked together for a long time, and I've had so much fun in this latest project. I'm thrilled you're going to be on our board. You bring so much expertise. I just want to start with my favorite question, and that is, what is the most interesting and important thing about you that has nothing to do with your work?
It's hard to say something that's important and interesting, maybe together.
Well, you can
so I'll do
default
two.
on
I'll do two
interesting.
things,
Okay.
if that's okay. So first of all, I think a lot of people don't know how much the arts are important to me. I, even growing up, arts, ballet, music, I played 3 instruments growing up, the oboe, the flute, and the piano.
Wow.
And have collected art for many years. My husband and I had an art gallery when we lived in Pennsylvania. And one of the highlights for me was being able to be on the board and to then chair the Kimmel Center, which I now think is called the Ensemble Arts Philly, but it is the second largest performing arts center in the country in terms of the number of people who come for various performances. So that's probably, I would say, maybe an interesting thing. I think an important thing about me is that I was ordained as a Presbyterian elder when I was 15.
Oh, wow.
And I think that shaped me a lot. And I didn't realize it at the time. It's something that I've come to realize over the years, because in order for me, for people who don't know, the Presbyterian Church is ruled by a group of what are called elders, and think of it as essentially a legislature that makes all the decisions for the church, as opposed to it being driven by the pastor. So at 15, I had to be able to have my own opinions and to voice them in a way that could sometimes be different from the other people on the session who were all my elders. And I think it helped me to become very diplomatic. I have a lot of people who'll say, geez, you're so diplomatic. I think it comes from that experience and then sort of part of who I am.
I love that. And I did not know that. And I'm really interested in your musical background. We can nerd out on that later when I'm in San Diego this summer. I'm actually just reading like this monstrous biography of Mozart. And it's
interesting.
Written by someone who is is a true expert and connoisseur of musical theory, which I think to do a legit biography of Mozart, you really have to get into music theory. And he or she, I don't know which one it is because I'm reading it on my Kindle, absolutely does. But it was a time in history where the oboe was advancing. He was using it very creatively. The piano was really in its earliest development in its modern form. The flute was incredibly limited, but he did some early experimentation with that. So you're like all over this education I'm getting.
Yeah,
So
most
that's
people are
great.
surprised about the oboe, right? Because it's not something that you would necessarily expect, but I just love the resonance and
Yeah.
how it sounded. And I took private lessons that allowed me to learn how to make the reeds, which were,
Oh,
particularly
interesting.
difficult. It was a great instrument to learn.
I'm a huge classic rock fan. I am barely a classical aficionado, yet alone a connoisseur. But if you listen carefully to most classical music, the oboe plays such a critical emotional role. And when it
Yes,
comes in, it's almost always like a moment.
totally agree with that.
So that's neat. All right. You now pretty much know everything I know about music. There's so many things to talk about. Let's start with the thing that is on so many people's mind. And particularly given your mortgage insurance background, you've been on the front line of this, which is housing affordability. We are in such a unique crisis because housing affordability is no longer just a problem for the coast. You're in San Diego, so this is old hat there. It's always been a problem in most of the major populated areas of California. We have an affordable housing crisis in Lincoln, Nebraska, and Boise, Idaho, and Nashville, Tennessee. That is definitely new. And so everybody's feeling it, which I think is one of the reasons why members of Congress have finally started paying attention to it. What, from your perspective, is driving this crisis? And more importantly, what are some of the things that we really need to be focused on to move the dial?
Well, I think one of the most important issues is housing supply. You can't really solve this issue. I always think about what are the short term things that we can do, but I also think about what are the long term things that we need to do to really solve a problem. And in this particular case, I think it's about housing supply. Municipalities need to reduce or eliminate some of the regulatory hurdles. I know some of the legislation in Congress is targeted at trying to help that happen. And the cost to build, when you talk to builders, they'll say it costs them $30,000, $40,000 just to put a shovel in the ground. And so we have to make sure that the cost of actually building comes down so that we can create incentives to build more housing. So I think that's one of the things. And it's important too, maybe for states and municipalities to consider making land available, right? That is
Hmm.
currently not being used or maybe not used for the highest purpose. I think back to my early days practicing law. When I finished law school, I clerked for a year for a judge. And then I became a real estate lawyer, which was really what I was interested in doing, and did a lot of deals in Baltimore. And back then, that's where there was a lot of public private partnership. And Baltimore was making land available to developers for a low cost in order to make its objectives go forward, the city's objectives go forward. And that was very successful back then. I think cities have to think about that, states have to think about that in terms of making land available for housing. And I think we have to think about grants to help people purchase a home. I mean, rents have continued to go up. So we could separately talk about that issue, but rents have continued to go up. And so if you're someone who is trying to just keep up with the costs that we're seeing, how do you save money to buy a home? The down payment has always been one of the biggest barriers to homeownership. And so, one of the great things that I enjoyed about working in the Federal Home Loan Bank system is that the affordable housing program requires each bank to put at least 10% of their net profits from the previous year into affordable housing programs, and up to 35% of that can be used for down payment assistance. Now, in that particular case, because it's highly regulated, it can be used only for people who are below 80% of the area median income, which makes it difficult when you're in a district like the one I was leading, that
Hmm.
was California, Arizona, and Nevada, to have that work in a lot of large metropolitan areas. So, one of the things that I did working with our team and our board was to do what I call the middle income down payment assistance program. That
Interesting.
was for people between 80 and 140%.
And that's often referred to as the missing middle.
That's exactly right. And my team was worried when I said, let's do $10 million to test
Hmm.
this out, that they wouldn't be able to get the dollars out the door before the end of the year because we were launching this kind of late May, early June. And I said, don't worry about it. I think it's all going to be gone. But if there's some left over, we'll just wrap it into next year. And that money was fully committed before September. I mean, there's a real need for this, and there's guardrails you can put around it. We required homeownership counseling as part of the program, but those are the kinds of things that I think need to be addressed.
In the construction space, one of the things that has come up a lot is the issue of acquisition, development, and construction loans,
Mhm.
AD&C. You've got a lot of financial institutions who rely on the federal home loan banks who do this kind of lending. For those who don't really know much about AD&C, what is it? Why is it important? Why is it hard to do? And what do we need to be doing more of to make it easier for lenders to invest in housing?
Well, I think, first of all, a lot of the large banks got away from construction lending
Hmm.
a while ago. Some of it was even pre the financial crisis. I remember, I'm dating myself, but you already did that in the intro. When I was at Nations Bank and I was the chief legal counsel
Hmm.
for the mortgage business, we had a pretty robust construction lending program. And it wasn't just for developers or builders, it was also for individuals who could acquire a piece of land, have a contractor build a home. But it became very difficult to manage. The bank would find itself in the middle of controversies between the builder and the homeowner. The bank didn't have anything to do with the controversy, but
Hmm.
it was still in the middle of it. And so a lot of banks just sort of got away from it. What I then found was that a lot of regional banks were doing a lot of construction lending, which I think was important. They were very close to the communities they were in. They were able to do that. Well, that also changed during the financial crisis. Everyone was focused on trying to reduce their risk. I think regulators were concerned that there weren't enough guardrails around those programs. And so a lot of lenders got away from doing construction loans. And we've had a lot of conversations about how do you re-engage lenders into doing construction lending. And while certainly those loans would be eligible collateral to borrow against for members of the federal home loan banks, the difficulty, I think, at this juncture is banks have gotten away from it. They're not set up for it. The people who had the expertise in those banks aren't there anymore. It's not as easy as just turning a switch or making capital available for that lending. I think there has to be a way to think about how to operationally support construction lending.
Hmm.
And whether that is something like a cooperative type of structure, I've thought about that, where essentially you have maybe one organization that is used by regional banks or banks just more generally, credit unions. Certainly, there are a lot of credit unions in California that provide mortgage lending that could rely on an organization to do the underwriting, to do the servicing, to do some of the things that would need to be done in order to support construction lending without having to be concerned about building that and having that replicated in what are smaller institutions, frankly. So I think we have to think about it not just in terms of capital availability, but we have to think about the operational side of making it work.
When you're underwriting a single family residential mortgage or even a multifamily mortgage, it's basically math. Do the
Yes.
numbers work? Everything fits in a spreadsheet or in an underwriting algorithm. When you're underwriting an AD&C loan, you're dealing with the quality of the builder, the construction components, labor availability, the reliability of the subsidy money to show up when it needs to. I mean, there are a lot of intangibles that have to be managed. So I get it why it's harder.
Well, and when you think about some of the affordable housing projects, right? I
Hmm.
mean, I was talking about the affordable housing program for the Federal Home Loan Banks. The other 65% of that money goes into grants for affordable housing projects. When you talk to the developers who are doing this work, it's very difficult for them to control the costs. And then the amount of grant money and that they need to get from all of the sources, and each source has their own set of requirements instead of coming together and kind of trying to work through a set of requirements. So for some developers, they stay away from doing this kind of work. It was interesting when I first went into the role of the CEO of the Federal Home Loan Bank, the state of Nevada didn't get any grant money because it's a competitive process and you have to set the rules and then you just grade the projects that come through for the applications. And in that particular year, lucky me, I had been the CEO, I think, for 3 months when Nevada didn't get any money. And
Hmm.
Senator Cortez Masto was sort of on the warpath with us about it. And one of the things that had already been done was we had already sponsored a housing coalition in Nevada to
Hmm.
help bringing along developers and so forth. But we really doubled down on that because we realized we had to also help developers understand how to put together all of the financing because we were just the last piece of money going in to close the gap. They needed to be able to raise money and know how to handle that. And we were successful. We were able to get more projects through the door over the next few years that were approved. But that is a real challenge in terms of
Hmm.
the work that it takes to make that happen.
Let's skip back a lot of bit and talk about the great financial crisis. That's something we're both intimately familiar with. That actually was when we first met. You were at Radian and came into Treasury. Have never forgotten. You were one of the most candid, straightforward, and transparent people we talked to. You really had the attitude and it never forgot it. This is not about hiding stuff. This is about figuring out what the heck we're going to do to make sure this doesn't happen again. So let's just go. In the years since, I can't imagine you being any other way. But it was very refreshing and unusual at the time. I can tell you that. But stepping further back, and one thing I think it's important for listeners to think about is, when you look at the risk curve on the mortgage business, and it starts out very high on the
Mhm.
left side of the curve, and it kind of slopes down into this tail and it looks just like a tail that runs down. And on the tail end is the government stepping in. We all know what happened there. At the highest end of the tail is, of course, the borrower's equity, and then is the mortgage insurance. After that, you have the lender and the investors, but that you guys are right on the line of the bleeding edge, so to speak, of underwriting risk. Everybody got the underwriting risk wrong, in part because we made mistakes around borrowers. And I say we because anybody who's involved in this shares some form of responsibility, often unintentional, but so what? In addition to that, we completely failed in underwriting the quality of the mortgage products. And I
Yes.
think product risk is one of the big lessons there. And it's something that I think the Dodd-Frank Act has done a great job of addressing, because we were always had the tools to deal with borrower risk, just people chose to ignore it. But on product risk, it was pretty ugly. And so the MIs took that first hit.
After the borrowers, of course.
Right. And then it was from there a very bizarre story as the crisis unfolded. So tell me a little bit about what was your experience in the run up and some of the flags you saw, and then the pressures. I think it's just a fascinating story. And particularly as the crisis unfolded and we had to dig ourselves out of it.
I had been at a couple of large banks, and then I had done a startup with some colleagues,
Mm-hmm.
and we sold it to MBNA in 2005. We weren't really doing much in the way of subprime because, frankly, we were fairly risk averse, even though a large part of our business was not originating loans ourselves to put in our own servicing portfolio, but rather we were a private label lender
Mm-hmm.
doing the work for others. But we sold it to MBNA, which promptly sold itself to Bank of America. And even though I had changed jobs, it was the first time I found myself in a position, because I decided not to go back to kind of what I was doing before
Mm-hmm.
that at the bank, that I was looking for a job. Luckily, because of all my contacts and having been on the board of MBA for so long, those opportunities were sort of abundant. But I always laugh because even with how crazy things were at Radiant, the other two offers that I came close to taking were at Fannie Mae and Lehman Brothers.
Oh,
And this,
okay.
right? And this was in the fall of 2006.
Mm-hmm.
So I joined Radian as the general counsel and corporate secretary of the holding company. And not only did we have a mortgage insurance business, but we also had a financial guarantee business. And for anyone who doesn't know what that means, you're also guaranteeing municipal bonds and other types of bond deals. They could be for educational organizations, community hospitals, but it's another type of credit risk that you're taking. And you're taking a lot of dollars, billions of dollars
Mm-hmm.
on one transaction. I joined Radian, and you started to see some of the issues, like with Bear Stearns, happening in the spring of 2007. And we were also at the time going to do a merger. So we had signed a merger agreement with MGIC, the largest of the
Mm-hmm.
MIs. And we were going through that process when all of this started to happen. Our chief risk officer left, and that's how I became the chief risk officer and the general counsel. And it was only supposed to last until we closed. We'd have to be on the podcast for at least another hour for me to
Mm-hmm.
walk you through all of
Yeah,
that.
I'm
But
sure.
let's just say both parties decided not to do the merger. And
Mm-hmm.
now I found myself, okay, now I'm really the chief risk officer. And I had been very focused on the financial guarantee business because those were multi-million dollar decisions. But at the same time, I had been hearing that the banks were making changes, the lenders were making changes to address some of the risks that you referenced in your question. But honestly, I wasn't seeing it. And also, we had people who were looking at data, and we would have a monthly meeting to walk through the data. And I'd have an 80-page deck, and I walk out going, I have no idea what this is trying to tell me. And so
Mm-hmm.
we brought on some really great people that helped us really understand the data. And I remember walking out of the first meeting with them, and they said that a lender who's no longer with us, that
Mm-hmm.
10% of their loans were defaulting in the first 6 months, not even the first year, the first 6 months. And if you think about how the MI business was operating at that time, everything was pretty much delegated. It was not, we weren't underwriting the loans separately. We were saying,
Mm-hmm.
here are our requirements. And the lenders were supposed to be underwriting the loans to our requirements, which wasn't always happening.
They were
And
barely
so
underwriting the loans at all.
they were barely underwriting the loans at all. So in that particular case, I said, okay, we're not doing business with this lender anymore.
Hmm.
And I remember the reaction that I got in the company, which was, you can't cut them off. They're this company.
Right.
And I said, okay, then this is what we're going to do. We're going to yank their delegated underwriting. They
Hmm.
can't underwrite for us anymore. They have to send the loans to us. I knew that by that decision, we wouldn't see any more loans from them. So they could feel like it was their decision to stop sending us
Yes,
loans,
nicely
but it
done.
was my way of stopping getting loans from them that we didn't underwrite. Not long after that particular institution failed.
You're being discreet about the institution, and it would be easy for me to jump in and say, oh, I know who it was. But the reality is, I can actually come up with 4 names, and it could have been any of them. So we'll just consider this a more broad brush of the guys who are
Yes,
no longer with us.
there were others. And so
Yes.
one of the things that I immediately started doing was saying, okay, let's come up with where we think the default rate, a reasonable
Hmm.
default rate is, and let's work towards that. And so we literally looked at all of the lenders we were doing business with, and I made what was frankly an arbitrary decision that if your default rate in the first 12 months was more than 5%, you still weren't getting it. And
Hmm.
now we're in 2008, then we just need to walk away. And there were 30 lenders that were in that category. And we communicated what we were, our expectations were. And I said, we're going to look at this again in 6 months and we're going to see have lenders moved in the right direction. And we had most of them that did move in the right direction, but there were some that didn't. And so at the end of the day, I had to stop doing business with 100 lenders, which was a tough decision. I thought I might be the shortest lived president of MI ever. But I also knew that in order to turn the ship around, that's what we had to do. The other thing we had to do was we had to make underwriting changes. And we couldn't give lenders 6 months to implement them. We had to do it in a much shorter time frame. And I remember being on the phone with the head of mortgage lending for a large bank that is still around. And they said to me, you're behaving poorly. I'll never forget that conversation.
Hmm.
You're behaving poorly. And I said, look, I hear you, but the only way for me to turn this ship around is to do this. And I'm sorry that you don't like it, but that's the way it has to be. And so those were the kinds of things that were going on. At the same time, my employees were worried, right? I mean,
Hmm.
and
Hmm.
I'll never forget, I'm typically a pretty upbeat person just in general. And I came in one day and one of the employees said to me, "You're smiling, so everything must be okay." And that's when I realized that everyone was watching me. Everyone was
Hmm.
looking at how I was reacting. But also, we started having town halls to talk about what was going on and what we were doing to address it. And one of my favorite town halls was when I felt like we had made our way through the crisis and I could just feel the difference amongst the employees that I
Hmm.
could tell that they also felt that. And that was very gratifying for me. We had the pendulum go way too far in terms of the leniency on underwriting, products, all of those things. And then I think Dodd-Frank did a great job of moving us in the right direction. I do think that we went too far the
Yeah.
other way. And so, for instance, at one point, we could only do loans that were 5% or more of a down payment.
Hmm.
And we spent a lot of time looking at data to show Fannie and Freddie that, in fact, the default rate between 3% loans 3% down loans and 5% down loans was very tiny so that we could get back to 3. Now, I never thought we should be at 100% loans or,
Right.
or any of that. But what we were trying to do is balance out, right, the risk profile so that people could still afford to get in a home, given the difficulty of accumulating a down payment, but yet not create undue risk for the system.
I think that's really helpful. And it was such a bizarre period because everybody was fighting for market share because we meaning the country and the system allowed so many really bad forms of mortgages out there that with resets that nobody could afford, that you end up with a race to the bottom because if you don't compete with the lowest common denominator of your industry, you're going to lose market share so fast that you're going to become irrelevant or go out of business just on that. Several lenders told me during the run up period that mortgages are like lender crack. We know it's killing us, but we can't stop.
Part of the difficulty too during that time was not only that lenders were doing way more of this, I think, than many of us appreciated, but also the irony is that the fact that so many loans were then being securitized was a good thing and a bad thing, right? On one
Right.
hand, securitization taking really hold brought more liquidity into the mortgage marketplace, right?
hmm
At the same time, part of the difficulty when we had these loans that were defaulting was that servicers didn't feel like they had the ability to modify loans to do the kinds of things that were necessary because they felt hamstrung by the requirements they
hmm
had as part of the trust of these securitizations. And so I remember being on a interview with someone from the Washington Post, and they said, "Why didn't loans get modified earlier?" And I said,
Yeah.
"Well, first of all, people had to recognize that we had a big problem." I mean, I remember who said that, was it Chairman Greenspan that said it was frothy or something? I
Yeah.
can't remember,
Right.
but
Frothy.
right, frothy, and Bernanke thought it was just
hmm
subprime. I mean, so there was a lot of not wanting to realize how bad this
Yeah.
problem was. So first you
Well, it
had to
was
do that.
subprime, but it was all strung together in ways people didn't understand. I always tell people, you want to learn about the financial crisis, the first thing you need to do is watch The Big Short
Yes,
and then
absolutely.
read the book because it goes into
Absolutely.
it's just as interesting, goes into a lot more detail, and it really gives you a great idea of what happened. And when my daughter went to business school, it was one of the first movies I told her, "All right, so now you need to watch this." And
Absolutely.
yeah.
Absolutely. And I think one of the things that was so important during that
Mhm.
time was the government stepping up and saying, "Here's how you can modify loans," because there was this concept of forbearance. Prior to this time, someone got behind, you could give them a forbearance agreement, but what you were really doing was you were increasing their payment for some period of
Right.
time to catch up. Well, these were people who couldn't afford their normal payment. So just
Mhm.
adding on the delinquency was not going to work. And so I think the government stepping up to develop HAMP and HARP was critical, in addition to
Mhm.
putting money into the
Yes.
system, but was critical to sort of make those loans. And in fact, I remember as a public company, we actually started reporting on our portfolio in that way. We were reporting on the loans we had insured from 2009 on, right? We were then
Mhm.
reporting on the loans that were HAMP and HARP. And then we're reporting on the loans that were still loans that were pre 2009 that were
Mhm.
not HAMP or HARP. But it was also able to give our investors a view on sort of how our risk profile was improving over time.
So let's skip ahead a little bit because now what we're talking about is after the crisis, digging out of this hole. At the same time, you've got the GSEs, Fannie and Freddie, bleeding cash very fast.
Yeah.
And there was a unique and a little bizarre role the mortgage insurance companies played in all of that to ensure they would stay. Could you tell me a little bit about that? Because, at this point, everybody's in the same sinking ship.
Well, I mean, part of the issue for the mortgage companies, right, was that it wasn't about liquidity. There were a few mortgage insurance companies that failed right at the very beginning. Most of them had too much of their risk in the subprime
Hmm.
business, or too much of their business was coming from one or two lenders that failed. But for the rest of us that were continuing, the issue wasn't so much liquidity as much as it was having adequate capital to continue writing business. And if you're an
Hmm.
insurance company, the way you deal with this is you have to write your way out of the problem. And so we really had to work hand in hand with both Fannie and Freddie, as well as our regulators, because as insurance companies, we were regulated by all 50 states and the district. Our primary regulator was the state of Pennsylvania. So I was going out to Harrisburg once a quarter. It was a big deal when we only had to go twice a year and then once a year. But we had to work with them to sort of agree on letting us continue to write business so that we could continue supporting the mortgage market, but also to help us sort of ride our way out. And at the same time, start working through what the capital requirements would need to be for the industry going
Hmm.
forward. For short, they're called the PMIERs.
Yeah.
So that was something that got finalized and implemented in 2015. But that was a journey that we had to go through together because you had some new entrants starting to come into the market in 2011, but they also had to get all of their approvals from all of the states and so forth. And so we kind of both needed to be there for the mortgage market to continue.
Before we could move on to the insurance crisis, you were also in the room where it happened, or at least after it happened, when Silicon Valley Bank failed. And that triggered a whole bunch of things and ultimately led to some really draconian capital standards in the Basel III reg, which would really hurt a lot of the people we're trying to help in ways that were not related. But I think it's interesting to know what the heck happened at Silicon Valley Bank, because it really blew up so fast. And the Federal Home Loan Bank of San Francisco stepped in very early to try to help stabilize them. And it's a real lesson, I think, in both how the Federal Home Loan Banks work when they have to intervene in ways they were pretty much designed to intervene when they were created in 1931, I believe, which was the same year that NHC was created, but also took a lot of heat about it because I think people just generally don't understand the role of trying to help with a liquidity crisis.
You're absolutely right about people not understanding what the purpose is of the Federal Home Loan Bank system. And there was a lot of swords being thrown, I'll say,
Hmm.
around that time. So, first of all, I always equate the Federal Home Loan Bank system being created to thinking about It's a Wonderful Life,
Yep.
right? If George Bailey had the ability to call up the Federal Home Loan Bank when he was having a run on his bank,
He wouldn't have to
then
go to Mr. Potter.
that's right. Or have his brothers show up and, like, raise money or
Yes,
whatever.
right. That's the other movie I told my daughter to watch.
And so if you think about it, the way the banks really are set up, and they're pretty conservative in their
Hmm.
underwriting, right? So everything has to be collateralized. So any loan that is being made has to be collateralized, and the types of collateral that you can take is heavily regulated. So in the case of a Silicon Valley bank, we were way over collateralized, by the way. So there was never, ever any risk to the Federal Home Loan Bank with
Right.
respect to the loans that we had. And even though people talked about the aggregate, it was actually a series of a number of different loans.
Hmm.
Most of the collateral were treasuries. You can't get much more safe, if you will, from a collateral perspective. The problem was that this was also a time when the Fed increased rates significantly. So think about that. You're a bank, you have this money coming in, you buy treasuries at a certain rate. And as interest rates hike up over a fairly short period of time, all of those treasuries are now underwater. And you don't want to try to sell them off, right? Because you want them to come back, hopefully, to the original value or close to the original value. Because you now have an asset that's lower in value, you're potentially now needing to use more of your line of credit with the Federal Home Loan Bank, which is based on your credit worthiness. They were highly rated by both S&P and Moody's until the day before the
Mm-hmm.
run, right? And we also, all of the banks coordinate with the regulators. So the Federal Home Loan Banks, who were regulators back in the day, had the regulatory authority taken away from them back in, I think it was the 70s. They weren't regulators. We were just cooperatives that do this lending. A bank can call up, the whole concept is that you pre-underwrite everything so that a bank can call and get money the same day, right? But we're
Mm-hmm.
not really set up like the Fed to be kind of what I'll call the capital of last resort, right?
Mm-hmm.
So a bank should be set up to borrow not only from the Federal Home Loan Bank, but also from the Fed. There were a number of things that went wrong. For one, Silicon Valley had not hedged their the interest rate on their treasuries. That was an issue. Number two, they had not set up their line with the Fed to borrow money. Now, given what we know now about that circumstance, I don't think that would have fixed the problem. But my team worked all night the day of the run to try to get them set up because we have agreements that we can do with the Fed, intercreditor agreements, where we can transfer collateral over to the Fed so that they can borrow from the Fed. But frankly, if it hadn't been for the cutoff time on that Thursday, they would have gone bankrupt the same day. So they had 40, I think it was $2 billion that came out during that Thursday. And by the next morning, there was 100 million more set to come out. You never saw during the financial crisis, where typically failures were much slower. You didn't see the FDIC take over a bank on a Friday, right? Or a weekday. Typically, it was the weekend. They had to take this bank over on a Friday. And I remember I was expecting a call from the Fed that Friday morning to kind of do more coordination. And the next thing I knew, the call didn't come. And then the next thing I knew, it was being reported that the bank had been taken over because of what was teed up to come out of the bank. I think one of the lessons from this is that the ability to move money electronically poses a wholly different risk than what we had previously. So I got a call from someone on our board saying, "What are you hearing about Silicon Valley Bank?" This was someone who was plugged into that sort of Silicon Valley community. At that point, it was early in the day. I hadn't heard anything. And I said, as a board member, you can't say anything to anybody, frankly, about this, even if we knew what was going on yet.
Mm-hmm.
But what was happening was that the investors or the hedge funds were calling the companies that they were invested in and saying, "Get your money out."
Yeah.
And so large amounts of money were coming out electronically, and it was too late to save them. There was sort of
Yeah.
no ability to save them. And then, if you recall that Saturday, there was an article in Market Watch because there was sort of this assumption that the banks that were also now at risk were the banks that had a large percentage of uninsured deposits. And so it was almost like printing a hit list of banks that Saturday. I remember being on the phone with Mary Daly, who's the president of San Francisco Fed, and she was saying to me, "We need your help getting banks to set up their lines and test their lines with us." I remember one bank president was upset with me because he was like, "We're a good member. You should be able to lend to us. Why are you saying this?" And I said, "Well, you're a great member, but we don't know how much money is going to be requested
Mhm.
from the system. And we, the Federal Home Loan Banks, raise the money that we lend through the capital markets." And so all of us as bank presidents were on the phone that Saturday and Sunday, trying to be prepared for how we would allocate funds if we couldn't raise enough. Now, of course, the Treasury stepped in and came up with the bank lending program that they
Mhm.
did Sunday night. But some of the lenders who were looking to borrow even larger sums reduced their sums, but it's the most money the Federal Home Loan Banks have ever had to raise and were successful raising in any one day, that Monday. And that was what stabilized the banking system going forward. Now, we still had two other banks that failed during that time.
Mhm.
Of course, Signature failed right on the heels of Silicon Valley. So that happened that following weekend. But First Republic took longer. And to some extent, I think that First Republic suffered from almost its proximity to Silicon Valley and being
Mhm.
viewed as being kind of like Silicon Valley. They actually had a lot more mortgage loans in their portfolio, but they continued to see a run. And as you know, Jamie Dimon led an effort to try to stabilize them
Mhm.
by putting more capital in. But it just was unfortunately about 3 weeks later that they couldn't survive anymore.
That
And
one really felt like collateral damage.
yeah, no, I think that's right. I think that's right.
One of the lessons from this is you should probably have a chief risk officer. As you know, as a former chief risk officer,
Yes,
Silicon Valley Bank was in between chief risk officers for quite some time. Really bizarre situation.
totally bizarre. And I think that you would think that that would have raised the issue of not having hedged
Yeah.
properly, right? And by the time they realized it, or, it was too expensive to try to
Mhm.
hedge.
Well, the FDIC had issued a warning months before, which makes a lot of sense, but then they did nothing about it. It's like standing in a burning building saying, "Hey, the fire alarm has gone off," and then not calling the fire department or getting some water
Well, that's right, and at the same time, there are more embers being leaping
thrown off.
onto the
Yes.
fire because every time the interest rates were going up over that 14-month period prior, it was increasing the problem.
Yes. Another thing that it's useful to have a chief risk officer who knows what the word convexity means.
Yes, that's exactly right.
And for those of you who are not financial geeks, then you can Google that one. It's a lot to understand because I'm still struggling with it. Easy to define, not so easy to manage.
True, absolutely. That's why you have to have the right people
That's right.
in the right
Not an English major
positions.
like me.
Right, exactly, or a lawyer like me.
There you have it. That's where the quants come in. We've been working together recently on the residential property insurance crisis. It's really
Yes.
property and casualty. You are the obvious person to reach out to for advice on who we should bring in to help us with that. And then partly because you inspired me, and partly because I probably went in subconsciously seeking to trick you into signing on anyway. You graciously agreed to help us set this up and it did such an amazing job with the transition now to an incredible leader, Sam Valverde, who I had the pleasure to work with at Treasury and who later had a great career at Ginnie Mae and Freddie Mac. But you're really one of the experts now in what people are experiencing and not the solutions because we're not there yet,
Right,
but the
right.
questions we need to be asking and the facts we need to be gathering to seriously address this crisis in a way that's sustainable. So we've got people who are beginning to pay more in their insurance and taxes than they do in their principal and interest, which is just incomprehensible, except that it's more and more common. And that it manifests itself in all kinds of ways. Many people are familiar with it from a personal standpoint, but walk me through kind of what you found has one been going on and what are the issues that are just not being addressed that we've got to figure out here.
Sure. So when you think you know quite a bit about a subject and then you really start delving in, you
Hmm.
realize how much you need to learn about that subject. And one of the things I think we identified early on was that while there was some commonalities between some of the insurance issues related to single family and multifamily, there
Hmm.
were also some differences. So I'll address that in a minute. But we've seen premiums go up considerably over the last few years. And to your point, now there are a fairly large percentage. I've heard anywhere from sort of 8 to 11% of people who are now paying more in taxes and insurance than they are paying in principal and interest. And it's also leading, unfortunately, a lot of people to be uninsured or underinsured. And
Hmm.
so when you think about the Altadena fire that happened, there were somewhere between 11 and 14-ish% of people who were uninsured. And part of the reason for that is because there were a lot of people who had maybe inherited their homes, or they were more senior people who had paid off their mortgages, and so they weren't required to have insurance by a mortgage lender. It was an expense they couldn't really afford. And so they just didn't. Then we also had a lot of people. And by the way, the overall rate of people being uninsured in California is about 10.5%. It's substantial. But then we had a lot of people who were underinsured, which meant that while they had insurance, they didn't have the ability to rebuild, which is what you want, right? People to be able to rebuild at the end of the day. So, one of the things that I think about when I think about affordability and I think about accessibility is also what are the terms of the insurance, right? Because if in order to afford the insurance, I have to have a deductible that I could never deal with if I actually have damage to my home, then it really doesn't work, right? Or if there are other terms and restrictions in my insurance policy that create a situation where I can't rebuild, then we haven't solved the problem. I think the other piece that folks don't really think about is the implications for municipalities. If I'm a municipality and this is my insurance, the property is my tax base. If houses have burned down, they haven't been rebuilt, maybe they're not going to be rebuilt, then my tax base has shrunk. And therefore, that creates an issue for the municipality in terms of the income that they've previously been getting when we know municipalities are already strapped. On the multifamily side, we saw the premiums increase by a large amount. I mean, we saw it a lot in the single family space. From about 2019, we saw premiums go up on average, sort of between 75% and 120%. Although you could talk to some multifamily owners who'll say that their premiums went up 500%. I've heard stories like that. But as a general rule, 75 to 100%. And if you're an affordable housing owner, your ability to pass that on to your renters may be even limited by the grants that you got to build the project or the loans that you got to build the project. And so then where are you? If you can't pay for it through using the rental income, then you either have to defer maintenance, which is not a great thing, or you have to cut services in
Hmm.
some manner if you have the ability to do that. And so there are a lot of issues surrounding this that are problematic. And so we really, in working through this, came up with sort of 6 areas. They do intersect and
Yes,
overlap,
right.
but sort of 6 areas to think about in terms of the work going forward. And one of them is housing resiliency and infrastructure. And I was talking earlier about how I always like to think about the long term solution. To me, this is the long term solution. You have to have homes and buildings that are more resilient to extreme weather events, whether it's fires or hurricanes or convective storms. And we've seen more and more of those things happen. And what it means is we're seeing more and more events that are where the losses are exceeding $1 billion for each event. And there are more of those in each given year. And while it might be 24 this year and it may be at 17 next year, it's still a lot of loss, which frankly, one of the things insurance companies have to think about is where do they put their capital? And they can make a lot more money putting their capital into other forms of insurance versus property and casualty insurance.
Hmm.
So, housing resiliency and infrastructure is about the infrastructure at the municipality level because I can make my home more resilient. But if the levee breaks or the dam breaks or the storm sewer overflows, it doesn't really matter what I
What you've
did
done.
to make
Yeah.
my home more resilient.
Frankly, what happened in Katrina in New Orleans, which is the levee broke.
Absolutely.
And that's end of
Absolutely.
story.
End of story. And so that's one of the areas. Another area is consumer education and transparency. So helping consumers understand insurance, how it works, how to think about shopping for insurance. It's not
Hmm.
just about the price. It's about the deductible. It's about what you get for the insurance. Helping people understand what to do in the case of a loss. How do they navigate that? But also, how do they make sure they're not taken advantage of? We've seen a lot of situations where people come in and say, "Oh, I can fix your house." And they take money, they don't fix the house, they don't know what they're doing, they gouge, those kinds of
Yeah.
things. And then the other piece is helping people understand what are the avenues for making their homes more resilient, right?
Hmm.
There are grant programs, there are lending opportunities. Why should you make your home more resilient? It might seem like an investment that doesn't make any sense. In some respects, it is another form of insurance because what we've seen is that houses that have been brought up to certain standards have weathered the storm, no pun intended, but that is what has happened, weathered the storm when their neighbors haven't. A third area is mortgage lending implications. So, we think about things like the ability to repay. Well, I mean, when most of us talked about the benefits of home ownership and the importance of thinking about getting a fixed loan versus an ARM loan, right? We didn't really spend much time thinking about the fact that taxes or insurance would go up. We expected them to go up maybe a little bit. Now we're finding that it's a much larger percentage of people's mortgage payments. So now the question becomes, do mortgage lenders need to start thinking about those issues? Should home buyers be thinking about not maxing out, right? Maybe the max I can afford is a $500,000 home, but maybe I should try buying a 400,000 or $425,000 home so that I leave myself some room because some of my costs could go up in ways that I'm not anticipating. and that I'm not totally maxed out on what I can afford. And we know other expenses are going up, right? The cost of living is going up. And all of this is way outpacing wage growth. There was a report that just came out from the Bureau of Labor Statistics that said that the cost of energy increases has wiped out already 1.5 years of wage growth. And that's just
Hmm.
one thing. So, how do we, as in the mortgage industry, think about how to make sure these loans are sustainable? Because we have seen this create some increases in defaults. The fourth area is multifamily insurance risk. And in particular, one of the important things about the multifamily space is the liability issue. And so someone gets hurt at a multifamily property, they sue the multifamily owner, right? A jury awards what's called a nuclear verdict, but way more money than kind of what the real damage is. Because the trial lawyer will say, send them a signal. Well, that signal has ramifications for every other homeowner, every other owner of property, that in terms of what the cost of the insurance is going to be going forward. And one of the things that I didn't realize is that there actually is private equity out there that is helping to fund this litigation, right? And they get a piece of it. So they're getting a piece of it, the attorney's getting a piece of it, the homeowner may be not even getting the most of it. And so Florida, as an example, did some tort reform. Their tort reform, and there's a balance here because you want people to be able to recover for their harm that's done to them if it really is the fault of the apartment building complex and owner. But at the same time, you want to balance that. And they were able, by doing this, to bring 37 more insurers back into Florida. There really is sort of this needs to be thought through in
Right.
terms of what's the right balance, ensuring that there's sustainable insurance capital. How do we make sure that insurers feel comfortable continuing to be in this space and to put their capital in this space? What are the options? Should there be some type of fund that steps in when a particular catastrophe raises the cost up to a certain amount? And what would that amount be? And how would that be structured? What would that look like? Would that give insurers the security to come in? You don't want it to replace reinsurance either, right? Because reinsurance is an important part of redistributing the risk from insurance companies. But if there's not enough reinsurance, there has to be a way to do this. And then the last is really understanding the systemic risk. And I've talked about some of those in terms of what it means for defaults, what it means for the municipalities, what all of those things, what it means for the homeless population and
Hmm.
trying to address that at the end of the day. So those are the 6 areas that we've landed on to focus on. And I think one of the things that I've said to the folks that are leading each of these work streams is to sort of look at what are low hanging fruit. Are there opportunities to sort of find some low hanging fruit that could be implemented programmatically by lenders or municipalities or that kind of thing? Also, look at programs that are already out there. There are some innovative programs that are already out there. And are there opportunities to take those programs and make them models, maybe with some changes or enhancements? The point here is to get the stakeholders to start adopting some of these things. And I think once they can prove themselves out and people can understand that they're working, we see the adoption rate increase.
It's a lot.
It's a lot. It's a very complex and thorny problem. And that's why it's been so important that you had the concept of bringing all of the voices to the table. And I think that's one of the things that NHC is really equipped to do and has done in other areas, because there are a lot of different opinions about what's causing these issues.
Hmm.
And it's not just one thing. This is not a
Right.
simple one and done, we can fix it. Those opinions have to be thought through. They have to be matched to the data and then coming up with solutions. And this is one of those situations. Well, there's probably every situation probably this applies to, but this is one of those situations where we can't let the perfect be the enemy of the good. There's no one that's going to have their idea perfectly dealt with, right, in order to get to a place. But if we don't come up with ways to resolve these issues, then it will be to the detriment of all of us.
And we'll all pay.
We'll all pay.
We're already starting to pay because when we look at Hurricane Helene, the uninsured losses were 2 to 3 times the size of the insured losses. And we're
That's
talking about almost $50 billion from a hurricane that in part wiped out homes and businesses over 1,000 feet above sea level.
well, that's right. And that's where Noah
Who
was.
would think of that?
No one thought that. And so,
Hmm.
one of the things that I think is also true is that with changes that are happening, you can't necessarily know where these things are going to happen. I mean, they're still mostly happening. There's still mostly fires in California and
Right.
convective storms in the Southeast and the Midwest. There were tornadoes in Chicago recently. I don't necessarily think about Chicago being that issue. No, we had those issues in Missouri when I was living in St. Louis. I had to go into a few basements a couple times to
Yeah, me
to
too. I grew
to
up in
be
Michigan
safe.
and we got them there.
So I mean, it's so there are different storms, and even when you think about the resiliency,
Mhm.
different types of resiliency depending on where you live.
At the end of the day, it's a part of life and a part of the risk everyone manages, but there's no question that the frequency and the severity have increased dramatically. We can argue all day about why the climate is changing and what to do about it, but the science is pretty obvious.
That's absolutely right. And I mean, it's interesting. There was an attempt by, I think it was Zillow, and then there was another company that they were working with, and they were trying to model a resiliency score for homes. And it got a lot of pushback. I think
Hmm.
you can maybe still access it somehow, but it's not kind of right there in your face because,
Yes, I know.
folks really didn't like it. But at the end of the day, I worry about this, right? I mean, on one hand, if I'm buying a home, I should have some sense of what the resiliency issues are. I mean, when we bought our house here in LA, we got feedback from a structural engineer about how safe the house would be in the event of an earthquake.
Hmm.
And so I think buyers should have that information. At the same time, the risk is to the current homeowner that their property could go down in value and maybe they can't afford to do what's necessary to make the home more resilient.
Yeah.
Or if
Well,
they're in an area where they're right on the waterfront, that's a whole different decision, right? And so, some people would say, well, they should just buy somewhere else. Yes, but also that has implications for the current homeowners in terms of their values.
certainly does. And, humans are humans.
Yes.
That's not changing. The desire to not believe something is happening is also a fundamental human trait. It has been taken somewhat to an extreme absurdity with the whole climate debate. At the end of the day, denial ain't just a river in Egypt,
That's right. That's right.
which is as good a way to end a conversation about property insurance as I can come up with.
There you go.
Thank you so much, Teresa. Always a pleasure talking to you, whether we're recording it or not.
Well, absolutely, David. And thanks for the opportunity. And it's been a pleasure working with you on this project. I
And
look forward to
looking,
being on the board and working
too.
with you on this issue
Everything
and
else.
others. Exactly.
All right. Thanks again for joining us. Thank you for listening to this edition of Beyond Four Walls. You can visit the National Housing Conference at nhc.org. There you can learn more about affordable housing policies, affordability challenges throughout the nation on our Paycheck to Paycheck database, and explore membership in NHC for you or your organization. We appreciate your interest and look forward to working with you in the future. Until next time, I'm David Dworkin, NHC's President and CEO, wishing you a great day.
This podcast was edited by Resonate Recordings.